everyone, I'm Ella from Ella Rose Financial, and I'm here with my friends and collaboration partners, Katie McCann from Lowry Legal and Chris Hopkinson from Sentinel Risk. And Chris is a corporate protection specialist and Katie is a family lawyer. And so there's quite a lot of synergies in what we do. So we thought we'd just have a bit of a chat about the changes in the budget and what they might mean for our clients and just some different planning points to consider. How did we feel about the budget to start off with?
I think it was devastating for small businesses and farmers. I mean, that's the first point to make with the changes that were made, and they surprised everybody. No one was expecting that.
Yeah.
I mean, there was a lot of expectation around pensions and restrictions on tax-free cash, and there was a rush on money coming out of pension funds, but that didn't happen. But it's a bit of a disaster, I think.
Yeah, all the things that, everybody was sort of panicking about with pensions just didn't materialise at all, really. Obviously, from an inheritance tax point of view, they did. So that's going to make it tricky for a lot of people. For some people, it's really quite devastating in terms of how they're going to protect their family wealth and how they're going to pass that down. There's so much going on at the moment in terms of generational wealth planning. Yeah, there's a lot to talk about in terms of inheritance tax at the moment and different planning pieces. There's something where baby boomers basically are passing down a huge amount of wealth over the next few years. It's something like 5.5 trillion that's going to get passed down to future generations. And then obviously with the budget, that's, it's going to affect people in different ways.
When you mentioned farmers, Chris, I mean, again, nobody was expecting that bombshell to hit in terms of passing that generational wealth down or not being able to pass that generational wealth down. And we've been talking about how can we protect. So it's all about protection now and planning for the farmers. And from a family law point of view, whilst obviously we can't help with the inheritance tax aspect of things, we can help with how we protect their estates from other attacks. So a farmer, for example, might be seeking advice now about inheritance tax planning and succession planning, etc. Family lawyers will be able to come in and talk about, well, we're going to pass some of that down now during their lifetime in order to avoid the inheritance tax issue. How do we protect that then from divorce thereafter? Because they might not be giving a big chunk of their money back to the Treasury, but they might be giving it to one of their children's spouses if they go off and get divorced. So the whole idea of keeping the farm and keeping all that land within the family bloodline, as it were, is definitely something from a family law perspective. We are probably going to see loads and loads more post-nuptial agreements, I would say, where the families are sitting down working out, well, what can we do to mitigate this disaster of a budget? Because if we die, we're effectively just going to lose the farm. So we're going to have to start handing portions of it down now to try to prevent that. But I don't want it going to, one of my children's spouses.
So, Katie, is there a way that trusts could do that as well to protect the assets?
Against divorce? So people think trusts protect completely and that they can't be invaded and they can't be touched. That isn't the case. So, for example, now if a farmer decided to do something like that to try to prevent an attack from divorce, it'd be obvious that he's done that to try to stop any interference with the land and with the farm. But the court has the power to sort of break down that ring fence of the trust if they think that it's unfair, if they think that it's a sham. They can also deal with the trust if they think that it's a nuptial trust. Because what some people do is they'll set up a trust, but then the husband and wife will be taking income from it, but the actual real beneficiaries are the children.
That was why I was asking, because I know that trusts can be attacked. And that's, some people think trusts are the be-all and end-all, aren't they? And they're not.
And they're not the be-all and end-all. If you've got a long-standing family trust that's been in place for a considerable period of time before the parties meet and marry, and it's been in the family line, that's different. That is different, and it's much harder to step into that and try to do anything with it. What courts tend to do with that kind of stuff is they'll say, well, okay, I can't really touch it, can't do anything with it because it's been there for, 100 years or whatever. But what I can say is it's a resource that's available to the husband or the wife, because it might have been the husband's family's trust. So they'll say, well, it's inequitable, isn't it? So let's just ignore it altogether because he gets a huge portion of his income through it or something like that. So whilst the court might not break it down or mess around with it, it will still take it into account in some way, shape or form. So trusts are useful if you want to put an extra barrier around something and make something a little bit harder to get at, but they're not indestructible.
That's really interesting because, like Chris said, I think people just think, oh, it's in trust. It's just, it's out of the estate. It's perfectly fine. It can't be attacked in any way, shape or form. But actually, when you're looking at, the bigger picture from like a holistic point of view, it does still need to be taken into account. And I think talking about farmers in particular, they are generally asset rich, cash poor. So if they were to pass away, then the likelihood is to fund the inheritance tax bill in order to get probates, then they will need to sell some land or machinery or buildings, whatever it might be, because most farmers, it's a really hard profession. They're not sitting on a huge amount of cash. Their farm and their land is that's their world, basically. So if they're trying to protect that and pass that down, the reality is that the family, the beneficiaries, are going to have to sell some land at probably not, a preferable rate that they wish to do to actually sell it at in order to fund the inheritance tax bills. So I think that's a key problem as well, because obviously people, when they're passing assets down, there's an emotional aspect to it as well. And something like a farm, they've generally been around for years and years. And so, there's a big sort of attachment to it, really, isn't there? So they're not going to want to sell land and reduce their holding in order to pay that bill. So, yeah, there's going to need to be some planning around this kind of thing. I mean, Chris, you know about this, your long-standing career in insurance, but you can insure against inheritance tax.
Absolutely. Yeah, absolutely. I mean, you could, if you're gifting assets, there's obviously that could be caught up within an IHT situation. So there's ways of insuring for that. It's called gifting to VIVOS, which is a short-term policy over 7 years, which covers the liability. But then obviously with IHT as an issue, say upon the farmer's death as an example, you can insure against the liability through either term-based products or whole of life products. Now, the challenge there is clearly as people get older, these products become more and more expensive.
And farmers will probably be rated, won't they, because of the line of work that they're in. It's not like us that are just sat at a laptop, and in a cozy little office. There's certain risks that come with being a farmer. It's a very physical job. So, yeah, the cost of it might be prohibitive for some people.
Could well be, yeah. But but the key message there, I think, though, is that you can insure against the liability, but it's whether you've got the appetite to pay the premium. Probably, like Casey's saying, the most effective way would be to start gifting assets at an earlier stage than you would probably normally want to. But it's then how do you protect, for a liability from an IHT point of view over a 7-year period, but more importantly, against divorce as an example. Or something else, because once you've gifted an asset, you lose control of it. But then if it's into a husband and wife and they get divorced, then that asset, it could be split equally. So you might have to sell it to then realise that asset, which is not the intention of gifting it away for a farmer.
It's like 2 different issues, isn't it?
Yeah.
That are completely not related, but it could result in farmers and business owners, in the same thread, really depleting their estate with these different sort of like attacks on the wealth, really, isn't it? Whether or not it's the actual taxation or a family circumstance that might mean that some of the assets need to be depleted.
Well, it's a law of unintended consequences, isn't it?
Yeah.
There is a ripple effect through this change for IHT, this loss of agricultural property relief and business property relief. It has this huge ripple effect, which the government aren't bothered about. They're not bothered about assets being gifted and then being lost through divorce and stuff like that. They just want to get their hands on some cash, don't they? And it's the poor old farmers.
Problem.
Yeah. But there are solutions to it. Solutions from a marriage point of view, which Katie would resolve solutions through an inheritance tax point of view, which you and I can resolve.
Moving away from the farming issue, any other business owner that has any other type of business that isn't farming related, then they're going to be experiencing similar problems as well because of the limitations on business relief. I mean, in other businesses other than farms, then there's not necessarily an asset that you can pass down in terms of a physical asset, like a land or a building or anything like that, perhaps. But then it's shares as well. It's exactly the same, isn't it, Katie, in terms of giving children or grandchildren shares in the business? That's another thing that we need to have a think about if they were to get married.
I think we've got CGT issues and things with that, as opposed to necessarily inheritance tax issues. But it comes down to the same point, which is when a family is thinking about succession and they're thinking about what comes next, what happens when I die to my business, etc., then proper planning, proper advice can help to mitigate tax significantly. It can also save heartache and pain along the line. And it's just, it's all round a beneficial thing to do for a family. And whilst, it's a bit difficult and it's a bit hard to sit and talk about these things, no one wants to think about, what's going to happen after I've died type thing. But if you've got a business and you're being advised to transfer shares down through the generations, again, the last thing you're going to want to happen is that hard-earned business then being snapped in half by a divorce because you gave the shares to your son. For example, he separates from his wife gets 50% of the value of those. That's not what your intention was when you were passing things down to try to make a potentially exempt transfer to mitigate the inheritance tax. You were trying to protect the asset, not expose it to attack. So that's why, and we've spoken about this many times, I think there's lots of planning that people can get from tax advisors, from the insurance industry, financial planners, but they kind of forget sometimes about that you need to protect it from this big, massive elephant in the room, which is you might get divorced. So I call prenups and postnups insurance policies, not to step on your toes, Chris, in any way. But people will come to you for all kinds of different insurance around their business to mitigate against all kinds of different risks. Well, they also need the insurance policy to protect against separation and divorce as well.
Yeah, no, it's a good analogy thinking of it in that way. And then I think, this isn't sort of a change in the budget or anything. It's not necessarily on topic, but while we're here and we've got Chris talking to us, it's really a worthwhile point to make in terms of, does your business have a business will? Does it have a succession plan? So things like cross option agreements, shareholder protection, all of that kind of stuff, like that's really important as well, isn't it, Chris?
Absolutely. I've just been looking at articles for a firm, and because it's almost like an employee buyout, and they've formed a limited company to buy shares of the main company and so on. And looking at the articles of association to make sure that everything was covered up on death, because we were looking at key person cover and so on. And there was no mention of death in the articles of association for either the main business that they were buying into and also their own new company that is set up to buy those shares. So there was no allowance for what would happen on death. So even well-established, long-established businesses don't consider the issue of what might happen on death. So it's certainly an area that many businesses need to consider. And we've seen businesses that have had to close down because of that, because they've not been clear intentions around what would happen on death. So people have inherited shares and then tried to sell them and wanted the money back, to get the money out. Yeah. And the business has basically liquidated.
Shareholders, yeah. Yeah, that's it.
It's hard. Well, it does. It absolutely does. And that's because the right advice isn't being given at the time of the formation of the company or when shares are being sold, or, it can be very distressing, certainly for the founders.
I think that's the key thing, isn't it, Chris? Like getting some advice and doing some planning earlier on rather than after the horse has bolted. As Katie said, it's these insurance policies, basically having these structures in to protect things should the extreme happen, or it might even seem completely unlikely. Nobody wants to think about passing away, nobody wants to think about getting divorced, but in reality it happens, and it is, you have to just put your sensible hat on and be like, well, what would be the position if either of these situations were to happen, and how do we protect it? And businesses have got a hard run at the moment, haven't they, with all of the changes. And then we've got the employer's NI as well.
Yeah, it's hard to talk about these because it almost seems like an assault on success. So you've worked hard all your life, you've saved hard all your life, you've been diligent putting money away in your pension, you've built up a business, you employ people, you've been successful, and then the government comes along and says, actually, we want a massive slice of it. I mean, if you think about the changes to NI now, the average salary in the UK is about 35,000. So for an employer, that's going to cost them just under an extra £1,000 a year in additional NI. So that's nearly a 26% increase in an NI bill for an average employee. And that is unsustainable, I think, for many employers. And it could cause a lot of, there could be a lot of unemployment moving forward. There could be a lot of cost cutting and rationalisation. And then you've got the challenge of how employers give pay rises in the future, because it's not, when you look at employees, you're looking at total on costs. You're not just looking at salary, you're looking at pension contributions, additional benefits, NI, and so on and so forth. So there are ways now, I've been speaking to firms about that want to obviously look after employees. They want to make sure they attract and retain the right quality of staff, but they want to do it in a more tax efficient way. So we're looking at other additional benefits like group life insurance, group private medical, group income protection, where these are really valuable benefits and perceived to be valuable from an employee point of view, but a lot more cost and tax effective, because you can give that perceived increase in salary, but by an additional benefit, which you can offset against
like total compensation, isn't it?
Yeah, that's right. Yeah, and you can offset that against your profit, so it's much more tax efficient. I mean, and that then goes into other things around salary sacrifice on pensions, which is your area of specialism.
Yeah, well, that's it. And I mean, and I think just sort of talking about the particulars of the NI increase, it's, it was only quoted as a, 1.2% increase, which anything that starts with a 1, you feel like it's quite low, don't you? But actually, in reality, because they've changed the threshold, that's come right down. It's actually nearly 9% increase. So it's not as, you can't be as flippant about it as what, was first kind of thought on the day when they actually quoted these numbers, because 1% is almost like a marginal, it doesn't feel a lot, does it? But actually, in reality, as you say, if you've got a workforce with 10, 20, 30, 40, 50 people, that's still classed as like a small business, but you've got to find the money to pay this additional tax charge for all of those.
Isn't it? And it doesn't burn.
It's not like it's just a one-off cost either. This is year on year. You're going to have to build this into your business planning. Yeah, it's huge. It's going to have such a knock-on effect. I was talking to a business owner the other day, and it's a great business. It's a brilliant business, but it doesn't employ a lot of people at all. And they'd worked out it's going to cost them another £40,000 a year. It's like, well, that's another salary that you could have been paying somebody, within the business. Where is that money going to come from? So you're right. There's things that they're looking for efficiencies in that respect. And it's a good time for companies to revisit their pension and planning within the business, not only just for directors personally, in terms of funding their pension, because that's owner directors, it can be counted as a business expense. So you can do it as a company contribution, you see. But in terms of the overall workplace pensions, most of them have just sort of ticked a box over the last few years because of auto enrolment and, use somebody like People's Pension or Nest, for instance, just so that they can, meet the requirements and the regulatory requirements that are put on them as business owners to do that for their staff. And for some people, depending on the size of the company and whether they got professional advice at the time or anything like that, it was a bit of a box ticking exercise. So it would have been like, right, let's get it done. They had their staging date, let's get it sorted out. And then we just sort of put it to bed and then didn't really think about it too much. So the majority of them, as I understand it from talking to many business owners, they haven't been set up on what's called a salary sacrifice or a salary exchange way of doing things. But if by doing it as a salary sacrifice arrangement, how it works is that the employees are basically, essentially doing what it says on the tin. They're sacrificing part of their salary and reducing their salary in exchange for a pension contribution that would go directly into their workplace pension as an employer contribution. So what that means in reality, in sort of realistic terms for business owners, it will be reducing their salary bill. Hence, they will then reduce their NI costs. But it is quite tax efficient from the employee's point of view and the employer's point of view. And yeah, the numbers are quite staggering, really, especially for people with larger workforces. So yeah, that's one thing that I've been getting a lot of inquiries about. And I'm trying to sort of educate business owners on the different ways they can, do things. It doesn't necessarily have to be the box ticking exercise that they did for auto enrollment. They've got different options.
So why wouldn't a business have set up the scheme on a salary sacrifice in the first place? It just seems a no-brainer, doesn't it?
I know, yeah. So I think, to be honest, it was because auto enrollment was such a big thing. I don't think people really had the headspace for it, and they were just, I'd say, ticking a box and just sort of went down the easiest route. And salary sacrifice, it does require a bit of admin in terms of changing payroll and people's contractual benefits. But the pension schemes, they generally help a lot with that, and it is, especially in this environment now with the extra NI costs, it's worth doing the exercise. There's many more benefits to it than what there were a few years ago. From an employee point of view, there's a few things to point out that, it can affect, if you are reducing your salary, it can affect other benefits that you might get, from either your employer, if it's based on a multiple of salary, or through different state benefits, that kind of stuff. So there are things to be aware of, but in general, it does suit both the employer and the employee. So it's worth having a look at for sure. And yeah, so there's lots of other things that employers can do to be a little bit more efficient. Katie, you're moving into the wellbeing space, aren't you? Working with different corporates within your world.
I am. So obviously, as Chris said, it's what extra things can be offered to employees on top of, instead of, rather in place of, increased salaries, as it were. So the space that we're moving into at the moment is offering some discounted legal services to employers for the purposes of their employees. So we've created a scheme where effectively the workforce works in its most effective capacity when their employees are happy and they're not stressed. And they're not, they're not worrying about things. And then we can't eliminate that altogether. But for example, somebody could be going through a really difficult relationship breakdown. They're not saying anything at work. They haven't taken any legal advice. And it's affecting the way that they're working. It's affecting the working relationships with other people in the team, etc., etc. So we're offering these schemes now to employers where they can effectively link their employees up with us for free sessions of advice, where we go into employers and we do sessions of awareness as well. So we talk about the various areas where their employees could be affected. So that might be divorce, it might be they're buying a house, for example, as well. And there's arguments about deposits going down on properties. It could be somebody's about to die, and have people got wills? Have they even thought about lasting powers of attorney because of all these other things going on in the background? So it's effectively trying to help employers help employees during the various life events that they might encounter during the currency of their employment. And, the thoughts are, yes, it's well-being for the clients, but it's also well-being for the business because it's helping their employees through those difficult times. And it's just other ways of thinking about what can you offer employees as opposed to continued wage rises, which thinking I like the conversation that we've just had, it's not going to happen, I don't think now. I think that continued expectation for increasing wages year on year is going to be, it's going to be less and less. And there may even be a drive downward as well in salary, which is worrying. I think that's worrying for everybody in all different industries. But it's just going to be really interesting, I think, to see how this actually pans out across the country and the impact that it's going to have and how are people going to manage it. I think the salary sacrifice idea, Alan, is a great one. I think many small businesses in particular will not have thought of that.
No, as I say, they're probably not aware that it's an option. Auto-enrollment was and is a great initiative because it got more people into pension savings, and it did force employers to play a big part in that. But again, it was just something that was seen as a bit of a pain. And again, that was another cost to the employer as well that they had to factor in. So a lot of small businesses didn't really offer a pension before. And I think it's just, as we've all agreed, it's just a different way it's going to be just a different way of doing things. I really think there's going to be a lot of changes in how our advice is going to adapt to that. I was just thinking, Chris, what about PMI? That's a really valuable benefit with everything that's going on with NHS.
Well, absolutely. I mean, I'm the living embodiment of a PMI sales aid. I've been rebuilt on private medical over the last 35 years. I've had virtually every joint replaced and every bit of my back operated on. But that aside, it's a phenomenal benefit, both from an employee and an employer point of view. So from an employer point of view, it's a very cost-effective benefit. It means that if your staff become sick, rather than wait for months or even years on the NHS to be treated and potentially be off work for extended periods, they can access the treatment a lot faster. And that means you can get your employees back to work a lot quicker. So from a very sort of self-serving point of view, it's really good for an employer because you get your employees sorted faster. But from an employee point of view, again, it's a very valuable benefit because you can access the private medical treatment that you need to get yourselves fixed a lot faster. And the only downside to PMI is obviously there's a tax implication because it's a P11D benefit, whereas group life and group income protection isn't. Burden on an employee you could be talking £4, £5, £6, £7 a month. It's nothing. And to be able to access private medical for that level of cost is, invaluable. I mean, it staggers me that with the pressure on the NHS and the government saying how much it was trying to raise to pump money into the NHS, what it should have been thinking about is initiatives about relieving employees of the burden of tax on their P11D benefit, so that more employees who are offered PMI do join the scheme. So I look after a large number of group PMI schemes, but it's never mandatory that an employee joins, obviously because there's a tax implication. So the average take-up's probably around 60, 65%. Really want that 100%. And the way to achieve that would be to remove the P11D benefit on it. But governments just don't seem to get it
that way. Actually, I was just thinking, we're talking about auto enrollment, that it was forced upon everybody, to make it mandatory that you, unless told otherwise, you are a member of the PMI scheme, and this is going to be the P11D cost or whatever it, if they were to be kind enough to waive that as well, I don't know. But unless you opt out, then you will remain in that scheme. Yeah, I mean, that would have been a good idea, wouldn't it? I think we need to go and speak to Rachel Reeves.
Well, in Australia, they do. Yeah, in Australia, they do that. So if you haven't got your own PMI, you pay a higher rate of tax. Yeah. So, but if you have got PMI, you don't have to. So, in a way, you're forced to have it some way, shape, or form. So you've got pay for it. But the easiest way would be to offer a carrot, which would be to incentivize through removing the taxation element, and that would have been another way of relieving a burden on the NHS to encourage people to take out private medical, because they
said, it's going to help people get back to work, without the stress of going through this life event. You're getting helped with that, where you're up to from a legal point of view, from a medical point of view, you're getting the care that you need, you're getting the treatment that you need. And it's it keeps the cogs going, doesn't it? Like in terms of
Well,
having people back in work. And
with a lot of group benefits, you get access to tertiary benefits. So you get access to 24/7 GP services. You get access to virtual counselling or virtual physiotherapy and stuff like that. Yeah, so you get that through group life and group income protection. Then on some of if there's a claim, say on group income protection, you get access to early intervention services to help you stay at work or return to work faster. And then with private medical, obviously, you're getting the treatment that you need. And again, private medical covers stress and anxiety and things like that that people may suffer, and you can access counselling a lot faster than you would on the NHS.
Yeah.
I mean, you might have to wait.
Times are ridiculous.
12, 18 months easily, and you can access it within weeks on private medical. I just don't understand. The government are going to use private hospitals to try and reduce the burden on the NHS and try and bring down waiting times. Well, if they'd incentivise people to take private medical out, it'd have had the same result, but would have been a lot less painful.
Yeah, I know. There's so many things that obviously, us at the coalface, we can see that could, work and be really beneficial. But I mean, we're at the mercy of what they decide, aren't we? It's just that we then have to adapt and then work out what value we can add to people that are finding themselves struggling as a result of these legislation changes. And I think conversations like this are really useful to help educate people really on the different things that we can help with and the different options that are available. Because I imagine there's a lot of people who are just feeling a bit overwhelmed with everything at the moment. All their plans have had to change. And it's a lot. It really is a lot.
Well, who would have thought that the government would have attacked people's pension pots that have planned all their lives, saved all their lives, and then put their plans in place, to take the tax-free cash, maybe pay the mortgage off, whatever, and then you're taking your income, drawing your income down, thinking, well, I can pass on the residual pot if you're in drawdown to my family, and it wouldn't be subject to IHT. Suddenly, it will be subject to IHT. So you might have been under the limit initially, but potentially with a pension pot, you'd be over it. So you need to plan for that.
And house prices, so many people are being caught by inheritance tax that are actually, you would think of them as just fairly normal people that wouldn't necessarily have an inheritance tax issue, but you couple a house with a pension and it's really sizable. It's massive. And I think one of the key things as well is to bear in mind with pensions that depending on the age that you pass away, your beneficiaries may need to pay income tax as well as inheritance tax on the pot of money in the pension that's passed down. So if you die before the age of 75, then there's no income tax. It would just be inheritance tax. I say just be inheritance tax that would apply. But if you pass away over the age of 75, then it would be both. The actual net benefit that beneficiaries will get is going to be much, much lower. With pensions, they were always such an effective estate planning tool. And if you are approaching 75 and you haven't taken your tax-free cash, for instance, yet, I would urge you to speak to a financial advisor about that and have a look at, your overall position.
Spend. That's it.
What I've been talking to my clients about, absolutely, this is it. And it's quite funny because people that were previously fairly cautious about spending, even though I've talked to them about, present company included, Chris. But I mean, it's everyone's mindset is changing now. So everybody I was always trying to educate people on, right, okay, well, live the life that you want to live. Don't worry about how much is left at the end of the day. Everybody is still going to be looked after and everyone's going to be okay. But people still were a little bit cautious about that, even though we would do all the modelling and we knew exactly how much they could spend, how much they could gift, etc., etc. It just didn't sit comfortably with a lot of people. Now, the conversations I'm having over the last few weeks, it's completely changed. Some people who you wouldn't think would be too frivolous in terms of spending money are booking holidays, they're getting new kitchens, they're doing all of it. And I think it's the best advice I could give because you just, you don't know what's going to happen in life, do you? As we've said, all these different insurances that we're talking about. But also, B, what would you rather? You just enjoy that money, make memories with your family, go on that extra holiday, go wherever you want to go, do what you want to do, eat and drink the most amazing food you want to, experience, or just leave a pot of money that is just going to get whittled away. And there's all sorts of clever bits of planning you can do. as we mentioned, we can put insurance policies in, we can do trust planning and all different quirky bits and everything. But it is nothing like just spending it and enjoying it and making some memories, really. It's best advice.
Well,
It's a good plan, and I think that's a life well lived.
no pockets in shrouds.
I'm going to make sure Heidi listens to this, Chris's wife as well. I'm going to send her a copy before it's even released out there.
Oh, wow. She doesn't need any lessons in spending money, crikey. So my pension pot's depleting already.
Everyone follows us on LinkedIn and everything. We're going to try and post more content like this, and hopefully it'll be some use for people that are trying to navigate the changing world that we live in. Let's put it that way.
Well, there you go. Well, it's always best to talk to people, and that's the key with all of this, isn't it, really? Whether it's from a financial point of view, protection point of view, or a legal point of view, it's not your mate down the pub that's got the answers. It's professionals like us that you need to talk to, and we can help navigate some of the complexities of what's going on. It has been a very, very difficult budget.
I think navigate is a good word for it. We'll work through it all, but talking and getting advice and rather than burying your head in the sand and worrying about things, pick up the phone, because there's a huge psychological aspect to money and finances and, the worry that it can bring. It can all be resolved by just having a conversation. So, I definitely recommend having a chat with a professional if you're, struggling to get to grips with it all.